Hi everybody, it's Tuesday, August 26th, 2025. Today's episode starts with our headline, Trump equals Nixon, bonds disagree. You may have seen headlines today like these from CNBC discussing how Trump is essentially putting pressure on the Fed to lower rates with these two headlines here. Trump says he'll have a Fed majority to push rates lower after firing Cook. Here's what happened to financial markets after Nixon pressured the Fed. Of course, they're talking about rates being too loose for too long and inflation getting out of control. So we did see a slight shift in the Fed funds futures, not very much, like 1% higher chance of 2 cuts by October, and then for the September meeting, raising the chance of 1 cut by 3%. So was it this news or something else? What pushed the Fed funds to suggest a little bit more of a chance of a little bit more cutting? Was it any of the economic data today? Not at all. In fact, all of the data seemed stronger than what the markets had been expecting, according to investing.com. So my guess is that the shift in the very, very small shift in the Fed funds futures was off of this news. But bigger than that, what does the 10-year note yield have to say about that? Now, if the market was worrying about Trump being the next Nixon and pushing the Fed into being too loose for too long, inappropriately, in order to let inflation get out of control, we'd see the TNX, the 10-year Treasury note yield, go up. Instead, it actually dropped today. So markets are sniffing more of a slowdown more and more, despite things like this, which tell me that it's saying that the market needs these cuts, that the cuts are not going to be inappropriate. Another thing to spot check, of course, is the 5-year and 10-year break-even inflation rates. They did tick up by 1 basis point, both the 5-year and the 10-year day over day. You can't see it in the they update the chart like a half hour after they update the number, but it did rise by 1 basis point today. The other piece of this is, with Nixon pushing rates to be lower in the early 70s, this was on top of very high demand with the baby boomers all trying to buy all the same things at the same time. We have nothing like that going on right now in 2025. If we have declining birth rates, we're below the replacement rate as far as I know in the United States. So I am not buying this narrative at all, along with the bond market. Moving on to the community topics, I wanted to do a YouTube comment response. I had someone comment in yesterday's video, wanted me to take a look at 2 stocks, IVVD and CHRS pharmaceuticals might be worth putting on your watch list, says commenter. Thank you for your comment. Let's check it out. First off, reminder, Robschild is essentially a value investor. I'm looking for something that is very safe and will provide me with a pretty sure return. Along with that, I need to see a good earnings record. I need to see a company that is making money and that is clearly undervalued. When you take a look at these companies like IVVD, earnings per share, and we have every year reported here negative earnings, in other words, losing money every single year, that's not typical of value investing. This other company, CHRS, Coerce Oncology, is a little bit better, but not a super great record, with most of its years having negative earnings and on average losing money. Now let's compare this to another potential pharmaceutical company. We're going to take a look at Pfizer earnings per share. This company is very well known. It has a solid positive earnings record, although the earnings do jump all over the place. And with that said, the earnings ratio is not super high, currently around 13. That's generally pretty attractive for a value investor. When I average the past 10 years of earnings and multiply it by 25, I get a price of $60.50, which is a lot higher than its current price. However, I don't invest in pharmaceuticals, and a big part of the reason for that is that these companies that make drugs, their projects are typically hit and miss, and not only that, there's laws on how long that they're allowed to have exclusive rights to different kinds of medicines. The only way I would be interested in it is if I was a doctor myself and I had some kind of inside knowledge about a company's things going on. And maybe you might have that about a company that you're looking at, but I don't know enough about these companies to invest in them. So second part of community topics, do you have a stock for me to see? Comment below if I don't get to your stock. It's okay, comment again in another video, maybe I'll catch it and we can talk about it. The community here has led me to discover stocks that I would not have otherwise discovered. So comment below stock that you would like Robschild to cover. Coming up tomorrow, Wednesday, NVIDIA earnings. Very sorry for the mistake yesterday for those first 100 viewers. Anyway, Wednesday after the close, this could be a big market rocker. We also have some important economic data coming out this week. The most notable, besides the jobless claims on Thursday, we have Friday, personal income and savings rate, which I'm keeping a close eye on, especially lately, and the PCE, which is the Fed favorite way of seeing inflation. And of course, always don't forget about those tariff updates. Thank you for watching, liking, subscribing, commenting, and supporting Robschild. Support information is in the description of the video. Your support is greatly appreciated. No changes to the daily reminders for macro views, nor the crystal ball ratings, nor the Robschild portfolio. See my website in the description to see my views and reasons the way that I invest. The portfolio section is still under construction. I'm working on it, and I'll let you guys know when I feel it is complete. On to the charts, starting with SPX, the S&P 500, it rose by 0.4% today. Personally, I think Mr. Market is waiting for the NVIDIA earnings on Wednesday more than anything else right now. Bitcoin next. Within the past 24 hours, we dropped to a level of $108,765. I think it's a dead cat bounce on its way down to the $100,000 level. I will repeat, typically the stock market has been following Bitcoin, and with it clearly showing lower lows and lower highs, and with momentum picking up to the downside, I think Bitcoin and the S&P 500 are going lower from this point. To help emphasize the idea that even if Trump is pressuring for more cuts and it's going to work, whether that's the narrative you believe or not, the 2-year did drop today. And remember, the 2-year is more tied to the Fed funds rate because it's looking 2 years out into the future. The 10-year dropping today just confirms that the 2-year dropping is not necessarily a problem, at least on the day. DXY, the dollar did drop today, but only by a little bit. If you read the headlines, you might think that there are entities trying to dump the dollar as fast as they can, but the dollar isn't moving hardly at all right now. I talked about crude oil yesterday hitting that $65 a barrel marker and backing off, and I said on the show, you can watch it, I think pros are shorting at this level, and they would have made money today shorting at that level because crude oil dropped down to $63.30 now. The one market that kind of showed a little different story was gold today, rising almost 1% into this trend line. Are we breaking out to the upside here? I don't know. It could, but it hasn't yet. NVIDIA is also a large part of the QQQ, or the NASDAQ, and I do want to point out that this is starting to look a bit head and shouldery, is it not? I don't know. And does anybody else see this here? I mean, you can see this, right? We got our left shoulder, our head. Is this a right shoulder? Is this it? Is this the final top in the Qs? I guess we'll see. Maybe on Wednesday. I find it very interesting. XLP Consumer Staples is continuing momentum to the downside here. Today dropping 0.7%. This is one of those areas, again, where smarter money will rotate into as a defensive play. My take on it right now is that if, considering that smarter money is involved with the value of XLP, if money is running out of consumer staples, I don't take that as a good sign, especially with rates dropping, guys. Really not a good sign. But, let's ask Dr. Copper what he thinks about everything. What do you think, Dr. Copper? After all, you have a PhD in economics. Yeah, completely flat still. Nothing to see here, folks. Move along. I want to see something real, Copper says. The last chart I want to share today is high yield corporate spreads. Today at 2.8% on this chart from the Fed. This is the lowest it's been now in quite a while. We haven't seen it this low since beginning of July. And then before then, we haven't seen it that low since last February. And before then, when it was getting like ultra tight. The reason why market participants call tight credit spreads complacent is because when you lend money to a higher risk entity, say your neighbor's dog, and you only expect a little bit more interest than what you can get from the government themselves, it means that you're very, very confident that your neighbor's dog is able to pay you back the full amount with interest. In times when markets don't have such strong confidence or complacency in lending, the spread between junk bonds and treasuries can widen greatly. In fact, we don't typically go below 3%. 3% for me is sort of a magic number, but we do often explode as high as 7% higher than treasuries, 8%, great financial crisis, 20% you had to pay to borrow money as a junk bond issuer. By the way, that was the time to be loading up on junk bonds hand over fist. When credit spreads are this tight, it says that the market has a very high risk appetite for only a little bit more return, hence the word complacent. Tomorrow will probably be most exciting after the bell because that's when the Nvidia earnings come out. I'm sure we'll talk about it then. And that's all for today's show. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching and see you next time. Robschild.